This podcast series, part of the Wisconsin Entrepreneurial Bootcamp financial background series of podcasts presented by me, Phil Greenwood, will focus on the other component of return on assets, asset efficiency, how that influences the overall metric. So what we want to talk about is return on assets from a productivity standpoint, especially in how well or how poorly the management manages the assets of the company in relation to the sales and how that influences the overall metric of return on assets. So remember, return on assets, which in its initial form is net income divided by total assets, can be split into two separate ratios that are multiplied by each other. One was the net income divided by sales or profit margin component. That can be multiplied by the asset efficiency or ratio sales divided by total assets. That's what we want to look at. Again, remember that in 1990, our company, an example company, Semantic Software, had a return on assets of around 19%, but declined to 14.4% in 1991. Much of that due to lower profitability, as we saw in the common size analysis. Now we want to see, well, what's been the impact of how well or how poorly management has been managing, effectively or not effectively managing the company's asset base. When we look at this ratio, of course, now we gotta look at both the income statement and the balance sheet. So what we'll be doing is pulling the revenue number from the income statement and comparing that with the total assets of the company. Now, in addition to that, once we have the asset efficiency number, the sales divided by total assets, then we can look at, if that number has dramatically changed, then we can look at components of the asset base, meaning the cash, the receivables, and so on in relation to sales, to see if what those changes have had on the overall asset efficiency. So we take sales divided by the total assets for each year. We put it into a format like this. Simply take total revenues divided by total assets, or again, we can call revenues as sales also. That'll equal our asset efficiency ratio. When we plug it in for 1991 and 1990, you'll see that asset efficiency in 1990 was 1.57. So what that meant was that our revenues were about 1.57 times our total asset base. 1991, that increased to 1.78, almost 1.8 times our total assets. So in fact, and this is a case where the higher the ratio, the better. Management actually improved their asset management in relation to their sales growth. So they may have done a little better in controlling the growth in accounts receivable or inventory or other assets in relation to that $42 million increase in revenues. Now, other things that people use in relation to asset efficiency are some other ratios that are common in a lot of industries, especially in the high-tech industry. Just be aware that people will use ratios, not just sales divided by total assets, but may also use revenue or sales divided by the number of employees in the company. Or if they feel confident or have access to the profit number, like operating profit, earnings before interest and taxes, or net income, they'll divide that by the number of employees. What this provides is it gives you a sense for each person that's working at the company, how productive is the company in generating profits or revenues out of their employee base. Especially in companies that are not manufacturing companies but more of service-oriented companies where there's not a big asset base, these can be very, very valuable indicators of productivity within the company. Another component of a productivity measure, especially in relation to asset efficiency, is something called the cash conversion cycle. Now, the cash conversion cycle is comprised of three components. What we're trying to do is we're trying to look at how long inventory on average is sitting on the shelf before it's sold. How many days is it taking customers to pay their bills in the form of the day sales outstanding, offset by how long is it taking the company to pay its vendors in the form of accounts payable. What we do is we calculate inventory days on hand, which as you can see is the calculation up here, the inventory balance on the balance sheet divided by the daily cost of sales, cost of goods sold from the income statement divided by 365 days per year. That gives us a number called DOH, or days on hand, and that tells us on average how many days it's taking for inventory from the time we acquire it, build it, and ultimately ship it, how many days it's sitting there in general. Accounts receivable, the day sales outstanding ratio, the next one on this list, is simply taking the receivables, the amount that's owed to the company at the end of the year, and dividing it by the daily revenues. In other words, taking the revenues or sales per the income statement, dividing it by 365 days, and putting that in the denominator and having accounts receivable divided by that, and then that gives us a number which tells us on average how many days is the customer taking to pay their bills or pay on their invoices. Now, the third component of cash conversion cycle is what we call days payable outstanding. What this is it tells us on average how long a company like Symantec is taking to pay their vendors or pay whoever they owe for accounts payable. Similar to the days on hand, you take the inventory and divide it by the daily cost of goods sold. And what this is it gives you a sense of, on average, how many days is it taking to pay those bills. More importantly, what you want to do is you want to look at the overall conversion cycle. In other words, money has been expended and is sitting on the inventory, and we don't recover that until it's ultimately sold. Money is also sitting in the form of accounts that customers owe us, but we're able to offset where that cash is being utilized or stored by offsetting how long it takes us to pay our bills. And that's what the cash conversion cycle is, which is simply taking inventory days on hand plus the day sales outstanding minus the days payable outstanding. They give us a net number of days it's taking for the company to convert a dollar or whatever currency they have into cash. So when we look at Symantec's numbers, 1991 and 1990, you can see that days on hand inventory increased from 30.8 days to 59.1. The day sales outstanding, item B in the middle, that increased from 43 days to 58 days. And we offset that increase. Remember, the longer that inventory is sitting on the shelf where it's taking customers to pay their bills, is the longer the company doesn't have that cash. They offset that by taking longer to pay their accounts payable. And in this case, Symantec, at least as of the end of the year, 91 and 90, increased from 96 days payable outstanding to 159. Now, when you add the first two and subtract the third together, you'll see the cash conversion cycle went from negative 21.9 days to negative 41.6 days in 1991. Question always arises is, can you have a negative cash conversion cycle? And if you can, is that a good thing or a bad thing? Well, in this case, it's definitely a good thing, because what it says is that net effect is that Symantec is able to hold on to their dollars 41, almost 42 days more than it being tied up in inventory or accounts receivable. So in this case, a negative number, and the more negative it becomes from a cash conversion standpoint, the better. Now, one could argue that days payable outstanding of 160 days might be a little long, and in this instant, it may be just kind of a one-time event. But you can even see in 1990, they still took 96 days to pay their vendors. So in this situation, Symantec looks like it's effectively utilizing their cash flow in basically playing what we call the float, putting off paying their customers or paying their vendors, but yet getting their customers and inventory cash flow to come in before they owe their outside vendors.